GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's more organized than the boys' trip you swear is happening, but nobody's bought the flights. I'm your host, Kyle Reedhead, here filling in for Jay while he takes his week off. Fun time for his birthday. Today, we're joined by David Brickell, head of international distribution at Front Financial, that's ticker FRNT, and co-founder at the London Crypto Club. Today, we're going to discuss the macro landscape, of course, the dollar and liquidity, why all roads lead to currency debasement. And of course, we'll touch on Bitcoin and if it's a risk asset, risk off or risk on asset. Lots to be discussed in this episode. It's going to be a banger. I'm really excited. David also hosts his own podcast as well. So he's got tons of knowledge in this space. But before we get into that, I just wanted to share, I was looking through our Milk Road macro newsletter comments this morning, and I read one that said, now that I'm seeing your macro articles, I can't imagine not having this insights. Thank you, Milk Road. That's from a real reader who just discovered the Milk Road Macro newsletter. This newsletter is your shortcut to understanding how the big picture moves markets. Delivered straight to your inbox twice per week. Hit the link in the show notes below to subscribe. Today's episode is brought to you by Ledn, get cash without selling your Bitcoin, and Definitive, the leading multi-chain trading terminal trusted by funds, DAOs, and pro traders. David, let's bring you in. How you doing today, my man?
Yeah, good, Carl. Yeah, good to be here. How are you?
I'm great. I'm a little bit under the weather. So for those listening, you can maybe hear that. I'm supposed to be taking over the podcast this week for Jay, and unfortunately, I get sick. So not ideal, but I think I'm good enough that it doesn't sound too nasally. But yeah, it's good to have you on the show, man. Your content is awesome at London Crypto Club. We've been reading it for a while. So excited to have this chat. Let's just jump right into things. First, obviously, we've got some timely things going on right now with sort of the battle between Israel and Iran. I just wanted to get your opinion on what you make of this. Does this change your bigger picture on view on markets? Is it just another speed bump in sort of the broader bull market we've been in? What do you think about what's going on right now?
Yeah, I mean, I'm always of the view that you fade like the geopolitics. You fade those sort of stresses. In fact, if you look like historically, usually like when there's been any kind of wars kicking off after the knee-jerk dip, you tend to recover pretty quickly, and I think there's good reason for that as well. I think my thesis generally, like big picture, is that we're a function of rates and liquidity in markets. And when we see these wars, it just all leads to more debt, which needs monetizing. So greater liquidity, and actually markets tend to like that. So I think it's just a speed bump. I think you fade it. I saw someone say the other day on the X or Twitter, if you buy and nothing happens, you get rich. If you don't buy and you sort of and nothing happens, you're sidelined. But in all cases, if World War III kicks off, we're all dead anyway. So the risk reward stacks up to buy the dip.
Right. And would you say the dip is in by now? Like, are we fully in the dip, or what's your kind of overview quickly on markets?
Yeah, I think so, because when these things happen, and as someone who's managed risk before, when these things happen, risk managers, portfolio managers, they get the tap on the shoulder, right, to say, look, we don't know what this all means, what's happening, but the first thing you do is you either bring down risk and
Right.
kind of just reduce your risk exposure, or you put on hedges, you go buy puts or what have you to just give yourself a little bit of a hedge and then work out what this all means sort of going forward. So I think those initial moves get done pretty quick, and that's why you get these knee-jerk sell-offs. And then once everyone gets kind of comfortable that the world's not ending tomorrow, we're not heading for some great nuclear third world war, then the risk starts to get what we call gross back up. Hedges get taken off, and then we rally. So I imagine that like the lows are pretty much in for this conflict. Obviously, there's still some nagging headline risk out there, but I think most of those positions have probably been grossed down, and now you're seeing probably people waiting to actually just sort of scale back into risk again.
Right. I was just looking at the Bitcoin price here and to check out the pullback, and it went down like 6.7%, which is just a pullback for ants. That's so usually when something happens, Bitcoin's down, I don't know, 20% in like a day. And it's
Yeah,
just not doing that these days. It's a whole different world, I think, for Bitcoin, which is just interesting. Honestly, I didn't even look at the NASDAQ or
yeah.
anything, but it hasn't been that big of a pullback, to be honest.
Yeah, one of my analysts at FRNT Financial sort of pointed out that I think in April last year when we had some sort of trouble kick off in the Middle East, I think Bitcoin sold off around 13% or just over 13%.
Right.
So this time, yeah, that kind of 6%. It just shows you how Bitcoin's certainly becoming a lot more resilient
Right.
in itself, and maybe we come in a little bit more like less sensitive to these Israel-Iran headlines, but I think as we've seen actually, if you look at some of the equity sell-off that we had in April post the Liberation Day announcements, yeah, Bitcoin's holding in pretty well, like relatively to how it's traded in the past.
Yeah, yeah, we're definitely in a bit of a new world in that. And also maybe it's just we have news like, I don't know, every month, at least once a month, there's something where you're like, oh shit, the world's ending. Okay, what are we gonna do here?
Yeah,
Our audience just buys the dip, but it's like, how many times are we gonna try and go risk off and wait it out again? It's like, come on, guys, like we know nothing ever happens. So like just continue on upwards. What are we doing here? Anyway,
yeah.
so let's step back a little bit. I just want to get your sort of overall view on the macro landscape currently. There's a lot of sort of mixed views, I think, in terms of like, is the economy healthy or not? Is the labor market healthy or not? Is inflation going to spiral out of control or not? And you see a lot of mixed reviews everywhere.
Mm.
Just curious, like, where do you stand on these things on sort of a macro front?
Yeah, I've been writing in our London Crypto Club newsletter for a while now that things are pretty what I'd call like Goldilocks from a risk point of view. Not too hot, not too cold. We're definitely seeing a slowing US economy, but it's slowing, not collapsing, and I think markets are always okay with that. And we're also still seeing after some like seasonality in the inflation data. I think there was some front loading of purchases before trying to get ahead of the tariffs, which added to some of that seasonality. We kind of back in this disinflationary trend. All right, we're a touch above the 2% target, but there's no kind of reacceleration of inflation. If you look globally, I kind of think China's exporting deflation across the world, which is keeping a lid on things. So we're in this kind of like low inflation or disinflationary, slowing, not collapsing growth environment, which is allowing this kind of easing liquidity environment globally. It's allowing rates to come lower. So I generally think like it's a pretty benign environment, which when I think that rates and liquidity kind of dominate everything, and liquidity is clearly rising, we've not really got anything. I don't think at the moment to be overly concerned about. If I compare that where we are now to what certainly the market was pricing in April, and to lesser extent in March, I think the fear then was you had Bessent coming out saying that we're going to target sort of 3% deficits. That was coming down from Biden sort of running 7% deficits. So people started to take down their forecasts on growth around that. And then obviously all the fears around the tariffs. So we had this kind of stagflation narrative that really kind of sort of tanked equity markets in April, and obviously hit Bitcoin as a sort of risk asset there. And the fear around stagflation, that's like the worst combination for risk, right? Because that's a slowing growth, inflation, so the Fed can't do anything about it.
Right.
But we're not in that moment right now. I think if the risks to growth started to tilt to the downside, and we obviously will get the Fed later today, but that then they're in a position where they can react because inflation is not accelerating, and so I kind of think the macro is just in this Goldilocks scenario where now we can kind of focus on the fact that liquidity is plentiful sort of globally. We're still in this easier rate environment, and I think that bodes well for equities and for crypto and Bitcoin to do well.
From here, do you think, let's say next 3 months, 6 months, is growth picking up? Is inflation picking up, going down? Like, where do you see either of those going right now?
Yeah, I kind of feel like because there's so many offsetting factors, and like with the like trade disruptions,
Yeah.
like I kind of just think we're gonna like just sort of bump along. There's risks now, that inflation does, like we've not seen any evidence of the tariff stuff feeding through yet,
Right.
but that
That
potentially
could
is
come.
a bit lagged. it could come, but again, I still see big offsets because I still think growth is going to slow. I actually feel like rates are still too tight in the US. So I still think we're going to kind of see that kind of slowing growth picture, which should keep a lid on inflation as well. So I still think we'll be in this kind of benign environment where growth's going to continue just to grind a little bit lower.
Lower. Okay. Interesting.
Maybe inflation picks up a bit, but yeah, I don't think any significant. I think the Fed are going to be able to cut twice probably this year, and yeah, and I guess the thing that catches me out a little bit is again we're still running like these ridiculous deficits.
Right.
That's going to keep so all the people calling for recession. It's going to be really difficult when we're still running like 6-7% deficits in the US. Now, I still think that feeds a slower growth environment because the what I call like the debt intensity of growth is rising, i.e., you need more units of debt to get 1 unit of growth.
Right.
So each
Right.
year you need more and more debt, which is why like we're always in this spiral of ever increasing deficits. But yeah, so I feel like growth as things are right now can continue just to sort of grind a little bit slower, but nothing material. I don't see any kind of major risks that would concern me at this point.
Interesting. One of the takes we hear a lot is the last few months growth has really slowed down. Not really, but has slowed down mainly due to the fear around tariffs, right? So people just weren't sure what to
Yeah.
do. And so growth kind of slowed down there. Now that that's somewhat getting resolved, growth now can start to pick back up. Again, not super fast or anything crazy, but can start to pick back up. So maybe a little bit opposite to what you're thinking. Do you see that
Yeah,
being a
well,
scenario? Or?
I think my pushback to that view would be I think there was a lot of front loading
Right.
of trade and you know purchases and whatnot. So I kind of actually think like growth is slow as that kind of front loading
Be a
and that
little bit longer.
inventory build and what have you starts to sort of run out a little bit.
Right.
But then again, there's a little bit more certainty, so that's going to kind of help the animal spirits and all that. So I think these factors will kind of offset each other, and that's why I just feel we just sort of bump along and don't do
Right.
too much.
And ultimately that's good for risk assets, I assume.
Yeah, 100%.
Yeah.
I'd say I as someone spent like 20 years macro trading, sales, started life as an economist as well. It kind of pains me because I want to be more fundamental in my analysis, but I learned like the world changed post 2008,
Right.
so essentially what happened in 2008, and I call it like the Japanification of the Western world. We kind of hit the end of this sort of debt cycle, right? And the bill was due, right? And we had the global financial crisis, and the response was to artificially inflate all the assets that were the collateral that underpinned the whole financial system to stop it collapsing, right? So that for me sort of changed the game because once you go through that door, you can never really walk back.
Yeah.
So then we now really become this world of artificially inflated assets, which essentially is the whole like currency debasement sort of game that we're in, and we can never really get out of that. So we have we have liquidity constantly having to be sort of pushed and forced into the system. So assets in fiat based terms are going to be continually going up. The
Right.
only thing that ever really stops that is again if there's like we had COVID and lockdowns, something exogenous that kind of gets in the way of that, or we go through these mini periods, these windows where you know central banks start actually trying to sort of take the punch bowl away and actually tighten rates and drain liquidity out of the system,
Right. But those are
and
short
that's
term.
they're short term because
Yeah.
the whole system kind of needs that liquidity. So we'll be forever seeing like central bank balance sheets ratchet higher,
Right.
and then they'll sort of drain them a little bit, and then the next kind of problems come along, and then they have to really ramp that
Do it
back
all
up
over again.
again.
Right.
We saw it we saw it with the was it in 23 with the regional bank crisis,
Right.
and and again, I kind of, when I speak to macro guys, like, anyone who kind of did all the analysis and was bearish because they could see what was brewing in the banking sector, it's like, and the Fed won't be able to do anything because they're in this tightening regime. And then all of a sudden the Fed come in, and I think like within 2 weeks, the balance sheet expanded by 400 billion,
Right.
and
And Bitcoin doubled.
and Bitcoin doubled, right?
Yeah.
And it's like, you were kind of right, but you forget the willingness and the necessary willingness for these central banks to pump in liquidity. So
selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over 9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitive, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first 25,000 in volume. Visit milkroad.com/definitive and start trading like a pro today.
It's funny. We're interviewing right now for Milk Road Macro podcast hosts. We've talked to you about this already previously. And so I'm interviewing, there's like let's call it like more retail macro people, like people that didn't come from sort of the TradFi world. And then I'm interviewing people that came from the TradFi world. And when I talk to them about their like thesis around macro, the one thing I always notice is those who came, not everyone, but a subset of people came from the TradFi world. They always find reasons to be bearish. And I'm always just like, guys, don't you see through that yet? Like, haven't you seen how the world has worked for the last 15 years? Like, you spent your whole life in finance, you went to school for the shit and you haven't figured this thing out yet. Like, come on. And so it's always funny to see the difference between the two. It's so easy for retail people, I feel like, to understand this stuff. And then the TradFi people who are real macro people like you, who really get it. And they kind of see the bigger picture here. It's actually very simple to understand macro. Like, you always know what's going to happen, but there's just, I don't know, some TradFi people that just can't wrap their heads around that yet, I guess. I don't know if they're just they just don't want to, or they're like, this ruins what they do because they used to have such great opinions. And now it's like, your opinions don't matter because everything's going to go up anyway, because we're going to print money. We're going to go into more debt. Yeah. But anyway, it's been funny to watch.
Yeah. And it's like when you think like, central banks are targeting like 2% inflation. So say they get to 2% inflation, then the money supply, so that's 2%. So normally things, say equities and assets should go up 2% as well.
Right.
And then you tend to have the money supply globally expands around 6 or 7%. So that's going to inflate things. So in my head, it's like most things will go up by about 9%, 10%, like with nothing else happening.
Right.
So that's what you're battling. So then it needs like something, some kind of crisis or something to happen to really sort of dent that. But that's the kind of, that's what the way the river's running, and that's like the natural flow of things. And then I think, but particularly, in the last like decade and perhaps even more now with the advent of AI, you have some of these big secular trends that are just sort of massive.
Right.
And like life progresses. So again, you kind of these perma bears, you're kind of battling against like this kind of constant progress in technology, which is like, improving society. So it's really difficult, and statistically it just, it doesn't sort of weigh out. But what it is, Carl, is having worked with a lot of big hedge fund guys and, some of these like my clients, it used to be, and pre-2008, all the big money was made on the downside because you tend to like grind higher, and then the big like crises come or recession comes where we were more fundamentally driven, and then you get the 30% crash off, and that's where all the big sort of money managers made their money, because we're not making great returns, and then the years where everything crashes, that's where they're the hedge right against that. But now I think I always talk about the central bank put, the idea that central banks have removed that extreme risk scenario because of they discovered in 2008 we can just print money, like, to stave off any crisis, and the willingness to do that is high. Even governments, again, like, realize, we can get away in crisis situations with running ridiculously large deficits. And 2020 was like the perfect, like, playbook for that, where both arms were running. And I actually, Joe, I remember, because I kind of felt that, and I never really, in the early part of my career post 2008, I never really, I was listening to too many people. I was kind of like, look, all this QE and money printing, right? It's just going to inflate assets.
Right.
And some smart people were like, no, the reason we're doing this is because we're in a really bad situation. So you don't want to be holding assets right now. Obviously, that was the wrong thing, and then my kind of thesis changed. And I was waiting for the next crisis to hit, like, where proper crisis, where all the money printers get turned on. And COVID was it. And I remember, I think it was in April of 2020, and the Fed basically came out. They'd obviously cut rates, like, to zero, done some QE, and they basically announced unlimited QE. And there was a few things that I was looking at in the markets that kind of just were good indications for me of like market stress, and essentially the financial system, like, had frozen, right, and money wasn't able to flow around the system. And there were certain indicators that I was looking at that told me that I was looking to ease. As soon as I started seeing these indicators ease, which tells me that money's flowing through the system again, it was like, right, here we go now. This is it now. Now you go all in, get long. And I remember writing the piece. I called it like this risk dichotomy, because I was saying we're going to see the biggest post-war, recession post-war that we've seen, and at the same time stocks are hitting record highs. And I had some like hedge fund guys and that calling me up going, look, I like your stuff. This is ridiculous. Like, the world is shut, and I know your liquidity thesis, but not this time. This time is different. The world is shut. And we had that initial, like, before the QE, 30-40% like correction in equities, and then but it was like, this is just a dead cat bounce, right? And then we're going to make new lows. I'm like, how are we making new lows when the money printers are being turned on everywhere? And then alongside fiscal, they're literally stuffing money in people's pockets. I was like, we're ramping to new highs.
So you bring up this point of this time is different. And so far, ever since the great financial crisis, it's not. We just do the same thing over and over again. Yeah. Trump and Bessent came into office, and they kind of said, hey, we're going to do things different. We're going to create change in the US. We're going to, run a balanced deficit, et cetera, et cetera. Obviously, they got blocked on that. It didn't really work out. A lot of things happened where they basically pivoted, which, again, don't fade this. It's how it always works. What do you make? So there's two questions I guess I want to have here. It's like, first is like, does this ever end, or how does it end? Like, how long is this just going to go on for? Because everyone just keeps betting. Every time there's a dip or something, we're like, yeah, I'm fading that. I'll just keep buying because they're going to just keep printing money. How long is that going to go on for? And then two, what do you make of Trump and Bessent and the squad there of their first, I guess it's been about 5 months since they've been in office. What do you make of that? Obviously, they wanted to make change. They really couldn't. And now they've basically done a 180. So what do you make of what they've done so far and where they're going?
Yeah, I think the Mike Tyson quote of everyone's got a plan until they get punched in the face sort of springs to mind, and I think they came in with a plan and they got punched in the face pretty quick, and then they've had to do a complete sort of 180 on that, and I think it just speaks to the structural nature of the problems that I think Bessent certainly really wanted to come in and deal with, and to essentially, the US reserve currency, they essentially export, put manufacturing outside. We'll print the money, we'll buy all the goods, you manufacture them, and then you recycle that back in our debt, and that allowed US I guess the quality of life and consumption in the US to sort of rise. But at the same time, you were hollowing out like some of the working classes because all the manufacturing was going abroad. And Trump, I think, wants to rebalance that. And then Bessent, as a markets guy, is looking at the debt situation going, this is kind of unsustainable.
Right.
We're getting away with it at the moment, but at some point, people start questioning the sustainability. So we need to rein in the deficits. And then all of a sudden you start to try and do that. And things start to go wrong. So now Bessent's starting to say, well, no, we'll grow our way out of it.
Mm-hmm.
We're not going to be fiscally responsible anymore. But we're just gonna, if we just tell everyone we'll grow our way out of it, that'll be the sort of way forward. So I think they came in with all the good intentions. I just think the restructuring that would need to rebalance, trade globally, to kind of get deficits under control. It would be a very, very painful transition.
Right.
And you have a 4-year president, and at any stage, it's like, who wants it to be on their watch, where they come in and say, look, we're going to address all these issues, but it could take a decade to kind of really sort of rebalance these things, and it's going to be really painful.
Right.
Like, no one wants to be that guy, right? So they end up just going, oh, do you know what? Let's just kick the can down the road. And I don't. It's not obvious to me what can really flip that. Maybe the answer does become we get this sort of productivity explosion with AI and everything that's sort of coming. So that growth is off the chart, and then all of a sudden we can get deficits sort of back under control. But yeah, I mean that also presents its own problems, right? In terms of what the structure of the labour market will start to look like. So yeah, I don't think there's any easy answers, and the easy answer always is that red button to print money and essentially print away the deficits. And when it's there, it's hard not to use it. And I think we're now seeing them sort of look to that again.
Now, we haven't got any QE just yet. We're still actually technically QT, although they pretty much stopped at this point. So I want to get into just some of the tools that they can use. Before we do, there's one thing that Trump has done that he said he was going to do before going to office, which was he said sometime last year, the dollar is way too high. We need to lower the dollar. And since he's been elected, he's actually done, whether that was him or whatever, but they've done a pretty good job. It sits at, the Dixie's at like 98 right now. I think it was like 110 or something when he was elected, or when he first won the vote. And so they've done a pretty good job there. Obviously, dollar going lower loosens financial conditions that can be, again, bullish for risk assets. What is your what do you make of this in terms of the Dixie today? Do you think it goes lower from here? And how does this impact, let's say, liquidity or other things that you think it might be involved with?
Yeah, sure. I mean, it feels to me that, the dollar is being managed lower. I think the US are doing that. I feel that maybe some sort of Shanghai Accord, 2's been done, where they've made an agreement with China that you help us as well weaken the dollar. And I think with their major trading partners would have had those backdoor conversations, because
let me stop. How do they do that?
Yeah.
How do they just go, hey, let's weaken the dollar? What is the mechanism, or what do they actually do? Just curious.
Yeah, well, like with their FX reserves, essentially, they'll be sort of selling dollars and supplying dollar liquidity through a system. I mean, it feels like with China, they kind of, so China could sell dollars against like their other currencies. So for China, that then sees other currencies. So if China starts selling dollars against euros and sterling and yen, all those currencies get stronger, which actually benefits China, because then they can export more to those countries. Right. Okay. So they're happy about it. The US, meanwhile, are happy about it because their currency's getting weaker against everyone. So that's why I just feel, because we've had these little risk episodes where you'd expect dollar CNH, dollar China to really kind of pump, and it hasn't, and it's kind of now sort of staying below this 720 level. It just feels like it's being kept down there. So I think that's happening. And also, obviously the tariffs, they're not making any friends with tariffs. It's also for, you're going to have Tim Cook at Apple and all others saying, look, even with the best intentions in the world, to try and, bring production back home, again, it's a long process, painful process. We can't do that very quickly. And then at the same time, you're slapping these tariffs on. The easier thing for everyone, why don't we just have a weaker dollar and then we'll kind of naturally see sort of greater demand for our exports, and we'll kind of naturally like reduce demand for the imports, and that makes a lot of sense. And then the weaker dollar, the dollar's global reserve currency, it's kind of, it's the lubricant for like global trade and financial conditions. So a weaker dollar suits kind of everyone, because it helps to kind of spark sort of global trade and growth. For China, who are battling a deflationary spiral, China want to really sort of ease and cut more. They're already doing a lot, and again, this is adding to the liquidity pump. But what they don't want to do is they don't want to lose control of their currency and people start attacking their currency. And most people, even though they've got a basket, most people will look at dollar China. So they want to keep that stable. So again, a weaker dollar is allowing them to kind of ease more, which they're doing. And again, for them, if global growth is picking up, it's good for everyone. There's also, Carl, I think there's something like $17 trillion of debt that's issued outside of the US. So again, the weaker the dollar, the easier it is to fund that, and it just aids sort of global finance, which is why this is so good for risk. So it's kind of, I think people would have heard about the dollar wrecking ball, where when the dollar's strengthening, it's just killing a lot of emerging market economies. It's kind of tightening financial conditions. We're seeing that in reverse, and I think it's being managed that way, which is why I think it probably continues, because I think that's it. I think it's actually kind of an explicit intention from the US and their partners. Well, I think you're on mute, Carl.
I was going to say, I've shown the chart a few times of, if you just look at the Dixie and you look at the bull markets we've had, at least in crypto or risk assets in general, the Dixie's always coming down, right? And any of the bear markets we've had in the last 10, 15 years in risk assets, the Dixie's on its way up. And it really is almost that simple, right? You can also look at liquidity. You can look at business cycle. It's all sort of the exact same thing, and kind of all led essentially by the dollar, I would say. Although they're just all kind of integrated together, but the dollar is definitely the big one. So to see it down at 98, you think it's going lower from here? The last two bull runs we've had, so back in like 2017 and in 2021, it went down to 90 or below 90, actually. Do you think we get down there, or where do you think we go with the dollar?
Yeah, I do actually. And I say this as someone, by the way, who's, because it's funny, another macro kind of bear classic is always, the dollar demise and the end of the dollar. I still always think the dollar's going to be like the cleanest shirt in the Fiat laundry. They're all playing the same games, and again, it's very much the world's problem is the dollar. So I always think the windows for this to work are quite short. But I think it's suiting everyone right now to do it. The other interesting thing that when the dollar's weakening, which is why I think it's so impactful for risk, is what you tend to find is still like others like China and other other countries. They don't want their currency strengthening too quickly against the dollar. So what they do is then they'll be kind of intervening as the dollar's kind of weakening against their currencies. But what that intervention is essentially printing more of their own currency to buy up dollars to kind of just slow the move. And when you're doing that, what you're doing is you're kind of boosting your FX reserves by doing it, because you're essentially printing your domestic currency to buy up dollars. So you're boosting your FX reserves, and that's adding to this increase in global money supply. And I'm sure all your listeners have seen the global money, the global M2 sort of charts, and what Bitcoin looks like against that, but it also sort of risk generally. So it's allowing this explosion of the global money supply where the dollar's getting weaker. So I think it's got further to run. It probably, for me, it probably can run like until we get into a stage where the cutting cycle for the Fed ends, and then they're back to like talking about or thinking about hiking rates again. But I think that's a year out from now at least, maybe more.
Interesting. Well, let's talk about the Fed. We haven't really touched on them a ton, probably because the Fed just hasn't played ball. They've literally done nothing for, I don't know what it is, like 6, 7 months, 8 months, whatever it's been. They just don't want to do anything, which, to be fair, I don't know that they necessarily need to do anything. As we said, we're kind of like the labor market's not that bad, growth isn't that bad, inflation isn't that bad. So it's like, could they cut? Sure, but like, do they need to? Like, nothing out of the ordinary, I would say, is happening right now. Curious but they still have QT on, as I said. Like, what do you think the Fed should do? Or I mean, there's two questions here. What do you think the Fed will do? And what do you think the Fed should do? Because those are two different things. Do you think, you mentioned maybe 2 rate cuts this year. Do you think they need to go much lower? Are we going to get back down to like ZERP times where we're at 0%? Will we get QE, or like, what do you think happens here over the next, let's call it, year?
Yeah, I mean, I think firstly on the QT side of things, like they're going to have to end that. They're going to have to end that. Yeah, I think the point when the debt ceiling gets lifted, which it will get lifted, again, that'll just run to like the 12th hour. I think Bessent said in around August he thinks they run out of money. But once that gets lifted, then you have, and by the way as well, this all right now is good for liquidity as well, because they run down their existing cash reserves, right, to pay for everything. Once the debt ceiling gets lifted, then they can rebuild, they can issue net new debt again. So then they come to the market and have loads of debt that they need to issue. And then that's when you start to get some sort of funding issues, like in the market, where rates start to spike because they're issuing all this debt, and often they'll do it at the front end, and that's when the Fed will need to go, look, we can't add to the problem by doing this quantitative tightening and actually kind of letting the sort of balance sheet roll off. So that's when I think they end that, and it's more, again, it's less about what the economy is doing and inflation. It's more about these kind of the monetary plumbing in the US that needs this liquidity to be there. So I think they'll end that, and they've spoken about that, and I think they're going to be ahead of that. Hence, they've tapered QT already, despite them being worried about inflation and all these things. In terms of rates, yeah, I feel like rates are sort of too high. I think the problem with the Fed is that they're still very sort of backward looking, right? And monetary policy tends to act with a lag of like 12 to 18 months. So whatever the Fed do today is not going to impact until, call it a year down the line, really. Right. So, and if I'm, again, just looking the way things are going, there's signs of some softness in the labor market. I think you just want to keep sort of chipping away at that. So just keep getting the cuts in, just sort of keep sort of bringing them lower. Otherwise, but what typically happens, the Fed stay too high for too long, too low for too long. So they probably are sort of, going into with too high for too long camp. So then that's why I still think what will happen is, if a downturn comes at some point next year, or let's say with the let's say I can see when they sort of rebuild, when the debt ceiling lifts and they go and issue all this debt, I can see like some of the funding problems that markets have a little bit of a puke out, and then the Fed kind of start to panic a bit. And then what happens is that they'll cut rates, and because of this lag, like nothing happens, and then the data continues to come in soft, and they go, oh, we need to cut again, and then the data still comes, we need to cut again. So they keep going and going and going, and that's how I can see that we can get things lower. But I say my offset to all of this, and where I've been wrong, like, and where I thought rates would be a lot lower by now, is the fact that the fiscal deficit is just like, we're running still wartime like level fiscal deficits, and that's been a kind of change which maybe keeps sort of yields or rates a little bit higher than what they otherwise would have been, and maybe is extending these cutting cycles as well.
Right. Speaking of cycles, not necessarily cutting cycles, but I mean, in crypto, people think of these crypto cycles every 4 years. And I think a lot of people have learned over the last little bit that these are more liquidity driven cycles or just business cycle driven cycles. And this one's been a little bit different. Well, I guess we don't really know, but if you were looking at these 4 years, from the last one, it should be done some point in like Q4 this year. And I'm curious, like, if you can walk us through the next, let's say 6-12 months, where do you think markets go over the next little bit? Is it, typical cycle, 4 years, we're done Q4, wrap it up, we're going into a year-long bear market, we'll start things again the year after that? Do you think something's different this time around? Are we extending out? Like, walk me through sort of your analysis on the markets for the next 6 to 12 months.
Yeah, I famous last words. I think this time is different. That'll come back and bite me, I'm sure. But I think the reason why is I think people forget like the extremes of COVID, like
Yeah.
the
Agreed.
the extreme scenario we were in, the extreme response from that, um, the extreme reaction from inflation, like spiking up to like 10% or what have you. So we the cycle is naturally different because of those extremes,
Right.
and you kind of like anything, you have these big peaks and troughs before we kind of settle down. So this cutting cycle has been a lot more drawn out, and again, partly because of the fiscal that they're running. So I think because of that, we're going to see an extended cutting cycle to what we're normally sort of used to. And as I say, I think they'll probably cut a couple more times this year. There's nothing immediate on the horizon that that says we're gonna have to go quicker than that, but it's always possible as well. Again, like you think of the labor market, it's kind of what's the saying, up the stairs down the elevator shaft type thing. When that starts to fall, it can fall quickly,
Yeah.
because you tend to hire slowly, right? And then you delay firing people as long as you can. But then once you do it, like the announcements will come that companies are cutting 20% of the workforce. It's not like just we're letting a couple go. It's
Right.
like
Right.
we're now at a stage. So if we get that sort of slowdown, it can happen really quick, and then you get the sharper rate cuts. But again, I don't see that kind of stuff happening until into next year. So I still think into next year we're going to be seeing like a rate cutting cycle. We're just kind of going to see QT end in the next couple of months. There's the potential, if something slips up, that there's some form of QE going on. So that whole cycle, I think, has been extended, and I think that in itself it would extend the typical 4-year Bitcoin cycle.
Yeah.
And then the other thing, I think this has obviously been a very different one in terms of it's not been like a very sort of retail driven cycle. It's been very much what I call that real flows sort of coming into the space from the institutions. And that seems to be, I still think we're only scratching the surface on that. We're seeing more and more corporate treasuries start to sort of run a sort of Bitcoin strategy. We're seeing more and more sovereigns come into the space. So I just feel that's going to grow. So I kind of feel if you think liquidity, a lot of that liquidity is sort of driving more sort of speculative flows. These are like real flows that are coming
Right.
in that I think can extend things further as well.
The
So yeah, I think we can go have an extended cycle
higher for longer, but not talking about
higher for
rates,
longer.
talking about prices of Bitcoin.
Yeah,
uh,
I mean, the thing that will disappoint people on that might be, and I do think we're going to see less sort of downward volatility, like the
yeah.
pullbacks will be less, but then also we're going to probably see less upside.
Right.
Still good upside. I still think Bitcoin outperforms everything, but we're going to see sort of less of these sort of crazy runs, and we'll 30-40% a year might look pretty good, and then the pullbacks are going to be a lot less.
It's funny. People in crypto complain about. I mean, it hasn't been 30 or 40. If you look at Bitcoin, it's been like almost 100% every year for the last like 3 years. And people are complaining like this isn't good
Yeah,
enough. Like I
yeah,
want my old returns. It's like, what are you talking about? 100% is insane. Or even
yeah, yeah.
50% is insane. Like people even getting upset with like, I don't know, ETH. It's like, yeah, it hasn't beat Bitcoin, but like it's still been up 50 to 100% a year. Like that's still pretty darn good. Like I'd take that all day.
Yeah, and I always say to people like I'm not a day trader.
Yeah.
I have day traded, but like I want to capture like the bigger macro trends,
Right.
and I think investors make money, traders not many do. It's really hard to make money trading. I don't think anyone's gonna, or not many will outperform Bitcoin by
Right. Just
trading it and
holding it.
trying to
Yeah. Yeah.
capture.
Exactly.
Yeah. Now I try and with what I write about in my newsletter, I try and capture these more sort of structural macro trends that tend to run again in period. It could be anything from like 18 months to a few years. And they tend to center around like when the Fed start hiking again. If I'm gonna go underweight sort of Bitcoin and crypto, that's the time to do it and go like,
Right.
I'll reduce my exposure to 50%. But
Right.
overlaying all of that, you've got this secular trend and these network effects that's going to kind of be a constant positive for us. But we will still have the cyclicality. But I think we're going to still continue higher until we end this cutting cycle, and we're back into a world where globally central banks are tightening liquidity and hiking rates. And right now they're doing the complete opposite. They're all cutting rates, and particularly China, they're all sort of pumping liquidity in. So I kind of think don't overcomplicate it. We're going higher.
Exactly. So I think you've basically already answered the question I'm about to ask. And also, if I just look at the picture behind your head there, I'm pretty sure that's going to answer the question as well. But in a macro landscape like we're in today, what is the best asset to hold? What does your sort of portfolio look like? My assumption is you're going to answer it's Bitcoin, but maybe I'm wrong.
Yeah, Bitcoin. I think the big sort of it's hard for me to see, like, in the next, say, decade, what's going to outperform the two big secular trends of crypto. And so I think Bitcoin will continue to kind of lead on that. And yeah, I'm sure there'll be, if you can pick the winner, I'm sure there's going to be some other sort of like tokens and coins that will outperform Bitcoin. But on the whole, I think Bitcoin will outperform most things. But then again, from an equity point of view, I don't see why anyone holds anything other than tech and tech stocks. We're becoming more digital. We're in that exponential AI world. So the biggest companies in the world are going to continue to be sort of tech-based companies that are employing AI. And when I hear like some of, again, former colleagues and all these macro guys and talking about value and where valuations are, I'm like, I remember being on the trading. I remember being on the trading floor, Carl, for years. Like, it was like Amazon's a glorified bookshop. Like, it's so overvalued. It's worth more than every bookshop in the world, and it's so overvalued. But people just didn't understand what it was. Same with Tesla, right? Like, even Warren Buffett was. It's funny. I spoke recently on a podcast that I did with Justin Sun, and he was talking about his sort of lunch he had with Warren Buffett, and what he was talking to him about Tesla, and Warren Buffett was valuing Tesla in the way that he values like Ford and other BMW or have you, and it's like, no, but they're a tech company. They're a data company. They're not, like, you're valuing it in the wrong way. So I still think like tech outperforms everything. So in the way I'm structured, like about, call it like almost like 60-40. I'm 60% in Bitcoin, 40% pretty much in NASDAQ. I've not got time.
You're going to say 60-40 stocks and bonds. I was like, geez, who is this guy?
No. No, absolutely no point holding bonds. Like, you kind of almost guaranteed with, in real terms, to lose on that. But yeah, like, and then like mostly Bitcoin. I have a small percentage. I hold some ETH, I hold some Solana. I try to, again, I try and hold like some of, again, those sort of tokens that have like real sort of network value, and again, that you see the potential in, and yeah, like who knows? I'm sure there's going to be other stuff that massively outperform. I for fun, I'll mess around with meme coins.
Oh yeah, there you go.
yeah, but like for me, in my head, that is very much, I'm just punting. I'm not investing here. I'm just just let's take a fly. And it's like someone's always got you need to get in on this. This is the next big thing. And I've never hit that like 10,000 moonshot, unfortunately. But we all like to buy the little lottery tickets. But I think for your average kind of investor to be, have a chunk of your portfolio in Bitcoin, a few, maybe 10% max of around some of the other altcoins further out down the risk curve. And then if you want to be a little bit safer as well, then have a percentage in, say, NASDAQ, or hold some of the sort of Mag 7 or have you. I think you're probably going to outperform most hedge funds like over time with that combination. And yeah, you'll probably do quite nicely.
Awesome. David, that was fantastic. By the way, if you want to figure out what to buy in terms of what to punt and what lottery tickets to have. We didn't just launch Milk Road Macro, we launched Milk Road Degen, and we got a guy over there who's like in the trenches, and it's a hilarious show to watch and a hilarious newsletter, but the guy is crushing it. So he's your answers for that.
I kind of like, it's almost like reading your stuff and all the more degen stuff. It's like almost like my dirty secret. Like, cause I'm trying to be this respectable guy and a macro.
Like,
and
delete like, your cookies after you go onto the stage. You don't
it's like, what's this shit coin that I must buy today?
David, thanks so much for joining, man. This is a blast. I really, really appreciate your knowledge and the information that you put out for those listening. Where can they find you? Where can they learn some more from you?
Yeah, like we're on with London Crypto Club. We're on Twitter at LCC. We got the handle, but you can find us on there. Our newsletter is called Connecting the Dots. We're on Substack. You can sort of reach us on that. And then for any more institutionally focused, FR&T Financial, sort of look us up. We're doing some really interesting. We're basically building an investment bank for crypto. We're a public company as well on the Toronto Stock Exchange. So take a look at what we're up to. There's some exciting things. We're building out a lending borrowing platform and things like that. That's where you find me.
Sweet. Thanks, David. We'll put some of those in the show notes for everyone so you can get to them as well. David, that was awesome. We're going to have to get you back on because that was a lot of fun. And we both are going to be in London potentially near the end of the year. So we might look at doing a meetup with David's crew from the London Crypto Club and Milk Road. So we've had a few people from Milk Road saying, when are you coming to London? And I was like, I don't know, probably never, but I guess we might do it this year. So we'll let you guys know if we do it. Yeah, but thanks again, David. Really appreciate it. Everyone else, have a wicked awesome day, and we'll see you in the next one.
Cheers, guys. Thank you.
Hey, all. The Milk Road team is going to be at Permissionless in New York at the end of the month, and we would love to meet you there. We've got a meetup happening on June 23rd. Hit the link in the show notes to register. It's free, plus free drinks. Woohoo! Would love to hang with you and get a chance to meet others in the community as well. If you still need a ticket to Permissionless, you can get $100 off your ticket if you hit the link in the show notes. Hope to see you there. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.